about to hear my conversation with Michael Williamson, portfolio manager at Mackenzie Investments. In today's episode, we're challenging a long held belief in investing that sector rotation is the best way to navigate business cycles. We'll explore why sector based investing no longer reliably reflects cyclical or defensive positioning, and how new tools are giving advisors a more precise way to express macro views. From misclassified companies to catch all sectors, we'll dig into what's not working and what to do instead. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. I'm your host, Prerna Matthews, Vice President of ETF Product Strategy. When it comes to market cycles, the old playbook says rotate your sectors. But in today's market, those lines are increasingly blurred. Defensive sectors aren't always defensive. Growth sectors aren't always high beta. So how should investors express views on the cycle? To unpack this, I'm joined by Michael Williamson, portfolio manager at Mackenzie Investments. Together, we'll look at what's changed in the sector landscape, how advisors can build smarter positioning, and introduce a new approach that goes beyond traditional sector classifications. Let's dive right in. Michael, thank you for joining the podcast today.
Oh, thanks for having me. Excited to be here.
Great. There is a lot to talk about today. So let's start with the basics. For years, sector rotation has been a go to strategy for many investors' advisors to express a macro or cyclical view. What's the theory behind that approach?
Broadly speaking, we're thinking three different types of companies. We have defensive companies. These are companies where the revenue and sales don't fluctuate that much with the economic cycle. These would be things like telecoms, grocery stores, electric utilities, drug manufacturers. Where the economy is doing well or poorly, consumers tend not to change their consumption of these products. And then we have cyclical companies where the revenues are significantly influenced by the economic cycle. When unemployment is low, incomes are rising, consumers tend to purchase more of these products. And then they cut back when the economy is not doing well, like auto manufacturers, home builders, airlines, semiconductors. These are all sort of cyclical companies. And then we also have companies that don't fit into either of these categories. They have volatile earnings, so they're not defensive, but they also have earnings that are not related to the economic cycle. And so they're not cyclical companies. These could be startup companies or companies in decline, or there could be an industry that's not related to the economic cycle, but it has its own price fluctuations, such as gold producers or other commodities. When there's a shock to economic growth, and by that I mean new information that investors believe will cause economic growth to be higher or lower than previously expected, cyclical companies change their valuation very significantly because their earnings change very significantly. So you'll notice when I talk about these companies, I've given different industry examples of both cyclical and defensive companies. And to a large extent, industries do describe the general characteristics of companies. And so that's why investors have typically used sectors, which are the combination of multiple industries, to position their portfolio for expected shocks to economic growth.
Okay, so that's a great foundational discussion, but obviously the world has changed. The world has changed drastically over the years, and why does that traditional approach then to sector investing potentially not work today? Like, why are these sector exposures potentially not as predictable in terms of their defensiveness or cyclicality as much as they were perhaps a decade or two ago?
Yeah, there's a few different reasons for that. One is that the composition of companies within the sector is mixed, and in some cases this is new. In some cases, it's always been like that. In some cases, the business characteristics of the companies themselves have changed, and some is just issues with the classification system itself. So, if we're looking at sectors that are a combination of cyclical and defensive, a good example is financials. We've got banks in there, and we've got insurance companies. Banks tend to be very cyclical because consumer demand for loans is related to the strength of the economy. Insurance companies, on the other hand, tend to have a more consistent demand regardless of the economic cycle. And another thing that's happened here that's interesting, since the global financial crisis, regulations have changed to reduce the risk that large banks can take. So when you're even looking within banks, the large banks are now less cyclical, while the smaller banks that have less regulation affecting them are more cyclical. We've also had some changes to the GICS structure that's mixed cyclical and defensive companies together. And this is maybe a pain of modernizing the GICS classification. So in 2018, we created this new communication services sector. This was created by merging telecom companies, which are very defensive companies, with new media companies like social networks and search engines that are more cyclical. So this is another sector where there's a big mix of different types of companies in it. And then the companies themselves have also changed over time, often with the goal of making themselves less cyclical. If we look at Amazon as an example, they started out as an online bookstore. They're selling one product, very cyclical business, and then they expanded their product line, basically selling everything now, mix of staples and discretionary products. And then they've also become one of the largest providers of cloud services, which is a very stable revenue stream. It's very integrated into their customers' businesses, very hard to change. So this online retail business is now less than 40% of Amazon's overall business. And this is more of a general business trend. As companies have grown larger, they've shifted to more of a conglomerate model, operating multiple lines of business in different areas and different sectors. So now it's harder to classify Amazon. Is it a retailer? Is it a logistics service provider? Or is it a software service provider? Each of these businesses fits into its own sector and has its own characteristics. And there's also been a general trend for companies to shift into more of this service model in order to reduce the variation of the revenues with the economic cycle. So now, instead of purchasing products, we're often renting them, paying for them on a monthly or annual basis. And companies that can successfully implement this strategy smooth out their earnings and reduce their dependence on selling a new product to consumers every year.
Those are some really great examples that you've given us, many that we can relate to as investors, as consumers ourselves, to just to bring that to life a little bit. So let's shift the conversation toward then what do we do instead? So if traditional sector exposures are too blunt, you're getting a mix of cyclicality and defensiveness. Companies are not as clearly defined or clear cut in terms of what they're doing, what they're selling, how they're servicing their clients. How can investors and advisors think about investing across the business cycle instead?
Yeah, so investors should always look for products that are designed to achieve their desired goals. And this is the issue with using sectors. When MSCI is designing the GIC sectors and we're putting stocks into them, they aren't really thinking about whether they're cyclical or defensive stocks. So to use sectors to express a view on growth, the investor needs to be right about both whether growth will be strong or weak and how the companies in that sector will respond. And generally, I'd advise against making these what we call compound bets because they're more difficult to get right. You have to be right both on your growth view and on the response of the sector to that economic shock. So the good news about it is whether a company is cyclical or defensive is a fundamental characteristic. It does change as we've discussed, but it tends to change slow enough that investors can look at the recent history of the company or its characteristics to identify them. Um, so investors can pick the stocks themselves, but you'll want to have a diversified portfolio so that you can express your view on the economy and not get too caught up in the idiosyncratic events of individual stocks. Or investors can use a product like the McKinsey Cyclical Tilt ETF, which is specifically designed to invest in cyclical stocks so that investors can express their macro views in an efficient way.
Can you talk to us more about some of those main characteristics that are typically exhibited by cyclical or defensive companies? And feel free to use the ETFs as sort of a reference point in terms of how you're thinking about across all of the entire universe, not just kick sectors, but how you're looking at companies and determining their level of cyclicality or sensitivity to from a cyclical perspective versus their more defensive behavior.
Yeah. So when we look at the cyclical and defensive characteristics, we first consider those as their own characteristics. So when we're looking at defensive companies, we look at the volatility and beta of the companies. This is effectively the market's estimation of how risky a company is. And this is fairly common. You'll see this in low volatility ETFs, for example. However, I believe it's important to look beyond just price measures because the volatility of companies can change very quickly. And as a general approach, I like to look for confirming evidence from different sources. So for the defensive characterization, we also look at the variation of sales, earnings, and cash flows of the company. This should be the main driver of price volatility of the company. If the earnings can change a lot, then so can the price. If the earnings are very consistent, then generally the price will be as well. The profitability of the company is also an important consideration. Companies that have high earnings are more able to withstand an economic shock that decreases their sales than companies with low earnings. And finally, we look at the uncertainty of analyst earnings estimates. As an example, if we look at Tesla, their 2026 earnings estimate is 250, but the lowest forecast is 50 cents and the highest is over $5. Very large range, very uncertain where their earnings will actually come out. If we take Campbell's, the soup company, they also have estimated earnings of 270, pretty similar to Tesla, but the range on their estimates is just 240 to 330. So this is an example of a more defensive company. Now, when we're looking at cyclical companies, the key criteria we look for is the relationship between earnings and the economic cycle. And we do this in a number of different ways. We look directly at how earnings and sales historically vary with macroeconomic data is relatively slow moving information. So you want to supplement that with some more timely, faster moving measures. We also look at how analysts change their forecast for company earnings in responses to changes in macroeconomic conditions. And finally, we also look at how the price of companies responds to changes in macroeconomic expectations. And so, like with the defensive companies, we're tackling the problem from three different angles, looking at the financial statements, the analyst forecasts, and the market price. And then we supplement this with a measure of operating leverage, which basically tells us how much a company's earnings change in response to a change in sales. When we invest in cyclical companies, we want to find the ones that see the biggest change in their earnings when we have a macroeconomic shock. These shocks tend to affect the sales, and so we want the companies that are able to push as much of that sales growth through into their earnings.
Those are some great insights on both looking at companies from their defensive nature as well as their sensitivity to the business cycle from a cyclical standpoint. And as you've noted, a lot of advisors and investors who are stock pickers, particularly if you look at the Canadian or US equity market, or may do so maybe more effectively in certain sectors, but navigating the entire market, and to your point, being diversified enough in that approach to reduce idiosyncratic risk is definitely very important to keep in mind. And all of the sort of characteristics you've just mentioned and taking into account that kind of analysis. So, if we talk about factor exposure now, what role does factor exposure, or even subsector dynamics, play in identifying those characteristics that you spoke to?
There's some overlap for sure. An example would be quality. High quality companies tend to have high levels of profitability, low debt levels, usually a competitive advantage, and good accounting quality. These are generally characteristics that make for a good defensive company. High level of profitability I mentioned earlier, it helps a company to hold its value in an economic downturn because there's a buffer where the earnings can drop without creating a solvency risk for the company. So when we look to classify companies as defensive, we look at the quality characteristics. However, when you're looking for a cyclical company, it's not really advantageous to do the opposite and look for low quality companies. Sometimes these companies will have sharp rallies when there's a surprise to economic growth, but over longer periods of time, they tend to underperform. Value is also related to cyclical and defensive companies, but this is a little harder to disentangle. The two main factors that affect the company's valuation are how risky it is and how high its growth is. If a company is riskier, investors will demand more compensation to own it, so that makes it cheaper. If a company has faster growth, then it tends to have a higher valuation as it can sort of grow into its valuation, as we say. So it might look expensive on current earnings, but because the earnings will grow significantly, investors expect the valuation to come down over time. So these high growth companies tend to trade at high valuation. And the cycle is also a factor in here. When a company's earnings are low due to the macro cycle, it might appear relatively expensive because investors expect its earnings to rebound back to their normal level. So we can see these factors sort of contradict each other. And defensive companies tend to be both lower risk and lower growth. So that makes it hard to draw an exact conclusion on whether they're value companies or not. But what tends to happen over time is investors put more weight either on the growth or the risk component of valuation. So right now, investors are very focused on growth, for example, They're paying very high valuations for companies with high expected growth. So that tends to make cyclical companies look more expensive and defensive companies to look very cheap. So just to summarize all this, there is some overlap, but they're largely different things from each other, looking at factor exposures and exposures to economic growth.
Yeah, that's very helpful perspective. Great. Let's now turn our attention to practical applications. What do I do with this in my portfolio? So, for our listeners, in your view, how should advisors and investors think about rotating or tilting a portfolio in response to their macro view?
The first piece of advice that I'd give is that macroeconomic changes tend to happen relatively slowly. And there's also often conflicting evidence. If we look at the latest US GDP data, 3% growth, super strong. And then shortly after that, we had the jobs data, non farm payrolls, almost no growth in employment. These totally contradict each other. So these macroeconomic shifts tend to happen slowly. If you think back over the past few years, we had an inflation shock 2021 that lasted over 2 years. We've been in a growth shock for the last 3 years. So I'd recommend shifting your portfolio gradually. You don't necessarily need to catch the turning point or trade very rapidly. You just need to catch the big shifts, and you can sort of increase your positioning as your confidence grows. If you're looking to make the portfolio more defensive, there are a few different options. You can reduce the equity exposure and rotate into cash or bonds. And then the other option would be to move into low volatility equities or defensive equities. The main difference between these two options would be your certainty around the economic situation and your timing ability. The defensive equities will retain some equity participation. So they'll have a larger drawdown if the equity market's down than if you were in cash. But if the equity market continues higher, or at the bottom when the rally starts, the defensive equities will retain some of the overall market performance. So it gives you a bit more of a buffer to be wrong on that view. Between the low volatility and defensive equities, I prefer the defensive equities. I think low volatility equities are a good way to reduce the equity risk, but it only considers one facet, which is the past price volatility. And so I think you can do a bit better by looking at the fundamental volatility, the variation in expectations is just a more holistic approach. And then if you're positioning for a positive growth shock, your options are to increase your equity exposure or to purchase cyclical equities. Increasing equity exposure may or may not be an option. But the other side of that is you're giving up the return on your bonds or other assets in your portfolio. So purchasing cyclical equities allows you to benefit from the positive growth shock while not giving up other sources of return in your portfolio. Unfortunately, there aren't a lot of products in the market that allow investors to focus on cyclical or even high volatility equities. The main choice has sort of been leveraged ETFs, but that has a number of problems for an investor that's looking to make a longer term macro call. These ETFs borrow to get that leverage. And with interest rates still over 4% in the US, that's fairly costly. And then the second issue is that they're designed to double the daily return on the market, which means they need to trade every day. And that creates a lot of turnover and trading costs, and that ultimately hurts the return. And that daily matching also removes compounding from returns. And we all know how powerful compounding is over time. So if you look at leveraged ETF performance this year, S&P 500 is up 18%. The 2X S&P 500 up only 24%. You'd expect it to be up 30%. So that's sort of the drag you're getting with that. So cyclical stocks are not going to have 2X the risk of the markets. Um, and they don't have these issues while they still give you that outperformance potential. So it's a much better option than going with a leveraged ETF. So today, Mackenzie launched the Mackenzie Cyclical Tilt ETF, which is the first product in the market that allows investors to purchase cyclical stocks. It uses our own innovative proprietary methodologies that I've discussed earlier. And likewise, we've launched the Mackenzie Defensive Tilt ETF, which employs a more comprehensive process to identify defensive stocks than what you might find in a low volatility ETF. So I think these are good options for investors looking to position their portfolio for their expectations around the macroeconomic cycle.
Great. I appreciate that compare and contrast to the different approaches our listeners may be taking to get that exposure. So that's very helpful. And of course, your reminder that you don't need to jump on every headline. While the headlines seem to be coming and changing fast, the reality, to your point, moves a lot slower. So appreciate that reminder as well. We'll end off with one last question for you. For investors trying to be cycle aware, but also diversified, Any parting thoughts? You've shared a lot of great advice just now around a compare and contrast across different solutions, but any other parting words on how to navigate that effectively, particularly in the current market environment?
So I think the first thing is you want to use a product that's designed to express the view that you're trying to express. And then, as we've discussed, the sectors are not really the best way to do that. That's not their purpose they've been designed for. And you also want to use something that's diversified because if your view is on the economic cycle, you don't want um, the events that are happening to individual stocks to affect your outcomes that much. And then the other thing to keep in mind is that expectations and economic shifts happen relatively slowly. So you want to gradually adjust your portfolio. And the other important point is you're taking lower risk when you use a product that has an equity component to it, such as defensive or cyclical equities. This is generally preferable as you have a very strong view. You don't necessarily want to leave the equity market entirely. For example, when you have a defensive view, you can just lower your equity risk through increased exposure to defensive equities.
Michael, thank you. That was a lot of great perspective and very timely information to the market conditions that we find ourselves in today. So, thank you for the great discussion.
Thank you. Thanks for having me.
That brings us to the end of this episode of The Invested. As you've heard today, being cycle aware doesn't have to mean chasing sectors or timing the market. With a more dynamic lens, advisors and investors can better align portfolios with economic conditions while avoiding the noise and mismatch that comes with blunt exposures. Thank you to our listeners for tuning in. We hope this episode has given you new ideas for how to approach portfolio positioning. If there's a topic you'd like us to explore in a future episode, reach out through our blog or find us on LinkedIn. Until next time, stay invested. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income tax payable by any security holder that would have reduced returns.